Welcome back to the Deep Dive, where we take the transcripts, the decks, the analyst notes, and we boil it all down into what you really need to know fast.
And today we are digging into the Cheesecake Factory, ticker Cake, and their Q3 2025 earnings call.
Right, and this one was a real head-scratcher, a classic market paradox.
It really was. You had the company delivering this, truly impressive earnings performance, a big beat, but then you look at the stock and it just sold off the next day.
Okay, let's unpack this. Our mission today is to figure out exactly that. Why did the market punish them, knocking shares down about 5% when that headline EPS number looked so undeniably strong?
Management was telling one story, but it's clear the market heard a completely different one. It all boils down to the tension between their internal execution, which was great, and the external macro environment, which is getting weaker.
So let's start with those top-line numbers, just to set the stage.
Yeah, absolutely. Adjusted earnings per share, so EPS, came in at 68 cents.
Which crushed the 60-cent consensus.
Crushed it. It was even above management's own high-end guidance. Yeah. So, that's the good news.
And now for the catch, the trip hazard.
The revenue, that was the issue. They reported $907.2 million, which just missed the consensus of about $912 million.
And the comps, the same store sales.
For the flagship Cheesecake Factory brand, comps were nearly flat, just plus 0.3% year over year.
So there's the divergence right there. Management is on the call pointing to the bottom line, the EPS beat, as proof that they can execute.
And they did. But the market, especially with consumer stocks, is just completely obsessed with demand.
And that revenue miss, even a small one, combined with basically flat comps, that just screams slowing demand.
It does. For anyone investing in this space, you know that traffic is the leading indicator. It's the canary in the coal mine. A margin beat is great for a quarter, but if fewer people are coming in the door, it gets a lot harder to maintain that down the road. The market was just front-running that slowdown.
So let's pivot to where that beat actually came from, because the execution story here is really impressive. This is the blocking and tackling they did so well.
It really is. The consolidated operating margin was 4.1%, but you have to drill down to the unit level.
The RLPM, right?
Exactly, the restaurant-level profit margin. For the flagship, it expanded by 60 basis points to 16.3%. Think about that. That's 60 basis points of extra profit on every single dollar coming in versus last year.
A huge lever to pull when your sales are flat.
A massive lever. And it was even better in their other concepts. North Italia's RLPM was up 70 basis points. And Flower Child. Flower Child was up an enormous 140 basis points to 17.4%.
Okay, so how? What were the specific drivers to get those kinds of gains?
It was almost all labor and commodities. On the labor side, labor as a percent of sales actually declined 30 basis points.
But wages are still going up everywhere. How did they pull that off?
It's all about retention. They said it directly on the call. They've seen sustained improvement in manager and hourly staff retention.
So you spend less on training and your experienced staff is just more productive.
Exactly. It's not about freezing wages. It's about efficiency. Better retention creates real wage leverage. And then on the input side, cost of sales decreased 80 basis points.
So cheaper ingredients, basically.
For the most part, yeah. They had favorable commodity costs. They did flag one thing starting to move up, which is beef. But overall, the environment was a big tailwind for them in Q3.
And what about the balance sheet? They have this huge growth pipeline. They must have the cash to fund it.
Oh, absolutely. Total liquidity is strong, over $550 million. And critically, they have no draw on their revolver right now. So, yeah, they have the financial discipline to back up the operational wins.
Okay, so the margins were excellent. Let's talk about the concepts now, because this is where the picture gets really interesting.
Right.
The performance was so different across the portfolio.
It really was. The flagship Cheesecake Factory is still, it's just an absolute machine.
The AUVs are insane.
Over $12 million. Annualized unit volumes over 12 million. It's easy to forget how massive that model is.
But those 0.3% comps, that number hides what's really happening with customers.
It does, because that was built on 4% price increases, which was almost completely offset by traffic being down 2.5%. The only thing that kept the comp positive was a good mix.
And that mix is their new menu strategy, right? The bites and bowls.
Exactly. That strategy is clearly working. It gives people a lower price point, something more accessible, and it's driving higher appetizer attachment rates.
That's pretty smart. So you're giving a perceived value without having to do deep discounts.
All right. Management actually said the effective price to the consumer is about 100 basis points lower than the menu price because of these items. It's a very sophisticated way to handle a price-sensitive customer.
Now, contrast that with the star of the show this quarter, Flower Child.
About a quarter for them. Comps were up a massive 7.0%. In this environment, for a fast casual brand, that is just completely blowing the segment away.
Why are they succeeding so much when others are struggling?
Management's story is differentiation. It's a healthy, high-quality niche. And they've avoided the huge price hikes you've seen elsewhere in fast casual while keeping hospitality high. It's all about perceived value, and they are nailing it.
Okay, so now we have to talk about North Italia, the big headwind. Comps down 3% and traffic down a really painful 6%. What happened there?
Yeah, North Italia operates in that polished casual space, which is clearly feeling the pressure, especially midweek at lunch.
So what were the specific reasons they gave?
Two big ones. First, about 2 points of that negative comp was just sales transfer from new restaurants. Cannibalization.
Which cost of growing quickly.
To some extent, yeah. The second was about 1 point from the lingering impact of the LA fires, but still a 6% traffic decline is steep. It suggests they misjudged how sensitive that customer is right now.
And are they doing anything about it?
They are. They're already rolling out promotions like a new $25 small plate and pasta lunch deal to try and get those people back in the door. It shows they're being agile, at least.
Shifting gears to future growth, their development engine is running full steam.
Oh yeah, up to 25 new openings this fiscal year, and they're accelerating that to 26 new restaurants in fiscal 26.
And they're also investing in tech, right? The rewards app.
Right. The current rewards program works, but they're building a dedicated app for launch in the first half of 2026. This isn't just for show. It's about reducing friction for off-premise orders and reservations, which are still really important high-margin channels.
So let's connect all this to the big picture. Management was pretty blunt about the macro headwinds. What did they actually guide for Q4?
The whole tone just shifted to caution. They guided Q4 revenue to between $940 and $955 million. And here's the key part. That guide is based on a 1% step down in sales trends from Q3.
So they are actively modeling for demand to get worse.
Yes, they're baking in a 1% lower traffic run rate. And on the cost side, they flagged a specific headwind on labor from a Greek medical comparison that's going to hit them for about 50 basis points.
They also said that things got noticeably softer in October.
They did. They even tied it to the looming government shutdown, saying that back in 2019, a similar situation caused a short-term, 1 to 2% dip in spending. It just shows how volatile consumer sentiment is right now.
So what about further out? What's the early look for fiscal 2026?
They're targeting 4 or 5% revenue growth and a net income margin around 5%. They think inflation will be manageable, maybe 1-2% for commodities. The key is they expect sales trends to improve as the year goes on, helped by menu changes and easier comparisons.
So the big takeaway here is the P&L looks great because of their execution on costs, but the market is just completely fixated on the demand side, on that traffic deceleration.
That's the whole story. They're protecting margins brilliantly while staring down a really challenging top line.
All right, as always, let's be crystal clear. What follows is purely for informational and entertainment purposes. We're just exploring scenarios. This is not financial advice.
With that very necessary disclaimer, if I were pitching this to an investment committee, the trade thesis here is actually pretty straightforward.
Okay, let's hear it.
The thesis is that Cake's superior margin execution and the incredible growth of a brand like Flower Child are being totally hidden by these macro fears and the specific weakness at North Italia. And you can't forget, there's been activist pressure before to split up the portfolio.
So how do you play that? How do you isolate that hidden value?
The trade would be what's called a stub long. You go long Cake equity, but at the same time, you short a basket of their competitors, other mid to high-end casual dining peers.
So you're hedging out the general market risk, the weak consumer.
Exactly. You neutralize the systemic risk. And what's left is a pure play on Cake's better management and the massive growth potential of Flower Child and the other concepts.
And the catalyst for that value to be unlocked is a potential breakup.
It's baked right into their development plan. As they accelerate openings for Flower Child in North Italia, those brands become a much bigger piece of the pie. That makes a structural separation, maybe late 2026 or early 2027, much more likely. And that would unlock a huge re-rating for those faster-growing parts of the business.
A very interesting structural thesis built right off the Q3 results. So, to quickly recap, Cake delivered a clean EPS beat, all driven by operational discipline on labor and costs. But that was completely overshadowed by a small revenue miss that pointed to broad consumer caution.
And that leaves us with a final provocative thought for you to chew on. Management is laser-focused on using menu innovation to provide value, and they are fiercely avoiding discounts.
Right.
But the entire industry is rushing towards big O deals and heavy promotions to get people in the door. So the question is, how long can Cake defend its premium positioning with just quality and a rewards program before the macro pressure finally forces their hand?
That is the central question for 2026. Will their execution be enough to hold the line? Thank you for joining us for this deep dive. We'll be watching to see how those Q4 traffic numbers land. Until next time.